US-Iran war, what it means for the stock market right now. A war between the United States, Israel, and Iran is now underway, and it has already been going on for about a week. The conflict started after coordinated US and Israeli strikes on Iranian targets on February 28, 2026, triggering retaliation from Iran across the Middle East. Since then, markets around the world have been reacting quickly. Oil prices are surging, global shipping routes are being disrupted, and investors are trying to figure out what this war could mean for the economy and stock market. So in this video, let's break down three major market impacts of the US-Iran war. The first and most immediate impact has been energy prices. The conflict has disrupted shipping through the Strait of Hormuz, a narrow waterway where roughly 20% of the world's oil supply normally passes. Because of this disruption, oil prices have already surged. Recent reports show crude oil jumping to around $90 per barrel, one of the biggest weekly increases in decades. Higher oil prices affect almost every part of the economy: transportation costs, airline profitability, food prices, manufacturing costs, and when energy prices spike, inflation can rise again, which makes investors nervous. As expected, the war has triggered volatility in global stock markets. In the first days of the conflict, the Dow Jones fell more than 450 points. The S&P 500 and Nasdaq also declined as investors reacted to the geopolitical risk. This happens because markets hate uncertainty. When investors don't know how long a war will last, they often move money into safer assets such as gold, US dollars, government bonds. At the same time, sectors that depend heavily on cheap energy, like airlines and transportation, tend to drop the most. Interestingly, not every sector suffers during wartime. Some parts of the market can actually benefit. For example, energy companies. Higher oil prices can boost profits for oil producers and energy companies. Defense companies. Military spending often rises during conflicts, which can increase revenue for defense contractors. Precious metals. Gold and silver often rise when investors seek safety during geopolitical crises. So instead of a full market crash, wars often cause sector rotation, where money moves from one industry to another. The biggest long-term risk isn't the war itself, it's how long it lasts. If the conflict disrupts global trade routes or keeps oil prices elevated for months, it could slow economic growth and push inflation higher. That combination can pressure stock markets worldwide. So here's what investors are watching right now: oil prices and energy supply, global shipping through the Strait of Hormuz, inflation and interest rate pressure. Whether the conflict escalates or stabilizes, markets may stay volatile in the short term, but historically, once geopolitical uncertainty fades, markets eventually adapt and recover. If you found this helpful, please like the video and subscribe so you don't miss important market updates. Thank you for watching.